Welcome to the Deep Dive. Today, we're focusing our attention on a massive transaction, one that's really reshaping the landscape of B2B marketing and event technology.
That's right.
We are talking about Cvent's move to acquire ON24.
And this deal is one of the most critical signals we've seen recently. I mean, for anyone tracking large-scale enterprise technology spend, this is it.
Mm-hmm.
It's a clear marker that the event tech sector, the one that ballooned during the pandemic, is now entering a phase of rapid maturity, consolidation. We're moving away from fragmented, pure virtual solutions.
And moving towards what? Unified hybrid platforms.
Yeah, integrated unified platforms.
So our mission today is pretty straightforward. We're going to go beyond just the headline numbers. We really need to dissect the strategic why behind this $400 million merger.
And understand what it signals for the future of enterprise marketing, especially when it comes to managing that high-value first-party data.
This feels like it's about market survival, strategic positioning.
Absolutely. So let's start by laying out the essential framework of the transaction.
Okay.
Event technology provider Cvent has agreed to acquire the digital engagement platform ON24. It's structured as an all-cash transaction valued at approximately $400 million.
$400 million. That's a substantial investment, but I think the real story here, especially for anyone tracking the market, is the immediate shareholder return.
It is. Under the terms of the deal, ON24 shareholders are set to receive $8.10 per share.
And that 810 number, it's not just a rounding error, is it?
Not at all. That price represents a colossal 62% premium over ON24's closing price just before all this takeover interest became public.
Wow.
Yeah. I mean, think about the conviction Cvent must have to pay that kind of premium. It says two things to me.
Okay.
First, they believe the strategic asset is irreplaceable. And second, they wanted to shut down any competitive bidding immediately.
That kind of premium sends a powerful message to every other player in the space.
For sure. The ON24 board of directors, they unanimously approved this deal, and we expect it to formally close in the first half of 2026.
And once it closes, ON24 becomes a privately held company again, right? Under the Cvent umbrella.
That's the plan. It's also noteworthy how Cvent is financing this whole thing. They're using a combination of their robust cash reserves, which are sitting around, $1 billion?
About $1 billion, yeah.
And available debt facilities. This just confirms Cvent's strong liquidity. They can execute these huge strategic all-cash deals without relying on anyone else. This is a foundational move, not an opportunistic one.
So that's the deal on the table. But to really justify that $400 million price tag and that whopping 62% premium, we have to look back at ON24's journey.
We do.
For a lot of people, ON24 was basically synonymous with the pandemic era.
Oh, they absolutely capitalized on it. ON24 established itself as the enterprise-grade, cloud-based digital experience platform. They specialized in those highly interactive webinars and large-scale virtual events everyone needed when the world went remote.
The go-to secure solution for major companies.
Exactly.
And their recent performance suggests they weren't just some pandemic flash in the pan either. They clearly demonstrated this ongoing business resilience, even as physical events started coming back.
That's right. Just before this acquisition news broke, they actually exceeded Q3 2025 analyst expectations.
I saw that. Their EPS was, what, 3 cents?
3 cents per share, yeah. Easily beat the forecast of 1 cent. And the revenue came in strong at $34.6 million, which surpassed the $33.72 million prediction.
So this shows they weren't a distressed asset.
Not at all. They were a performing, strategically valuable company.
But the core of their value, the piece that Cvent desperately needed, it wasn't just the ability to host a webinar, was it?
No, it was the data. It was always the data they generated.
Right.
ON24's undeniable competitive advantage is its obsession with deep, high-fidelity audience analytics. Lead scoring. This isn't just who attended.
It's how long did they look at the pricing slide?
Exactly. Or which poll did they interact with? And what questions did they ask? That level of engagement data is it's incredibly valuable.
And you mentioned their proprietary AI technology. That patent had to be a huge piece of this puzzle.
It's pure gold in a B2B context. They recently secured a patent for an AI that automatically identifies and extracts key moments from long-form video content.
Using machine learning.
Right. It pinpoints the moments of highest user engagement or where a critical topic shifts.
Okay, so let's make that tangible for the marketer listening right now. What does that key moments extraction really mean for Cvent's overall data strategy?
It means immediate actionable intelligence. instead of a sales rep having to, manually watch a 2-hour conference recording to figure out if a lead is qualified.
Which nobody has time for.
Nobody. The AI automatically generates a score and highlights the 3 minutes of content that prospect engaged with most intensely. Cvent can now integrate that high-intent first-party data directly into its own systems.
And customers can use it instantly for lead nurturing or sales follow-up.
Precisely. It shifts the value proposition from simply managing an event to delivering qualified pipeline.
Okay, so now we get to the big structural driver. Why would Cvent, already a powerhouse in traditional event management, venue sourcing, payments, why drop $400 million right now?
It signals the existential need for consolidation.
Yeah.
It's driven by this overwhelming demand for unified solutions.
Event teams are just done with the fragmentation.
They're sick of it. Sick of the patchwork of point solutions. One tool for registration, you export that to a spreadsheet.
Import it into a second tool for payments.
And then use a third, completely non-integrated tool for the virtual delivery. The market is demanding one platform that handles everything seamlessly.
From the massive in-person conference to the detailed, personalized digital follow-up.
Exactly.
And the engine powering all that demand is the fundamental shift away from
third-party data.
You hit the nail on the head.
This is the macro shift that validates the price Cvent paid. For the last decade, marketing was built on third-party cookies and external trackers. That well is drying up.
Completely. Safari and Firefox already block them.
And crucially, Chrome is phasing them out. You add to that the tightening global privacy regulations, GDPR, CCPA, and relying on third-party data just becomes risky and unreliable.
So if third-party data is the sinking ship,
consented events are the new compliant data engine. They generate the highest quality, most compliant first-party data available.
Because when you register for an event, you are actively consenting to share your identity, your employer, your interests.
And your engagement level. That combination, identity, intent, engagement, all consented. It's irreplaceable in this new data landscape. Cvent was dominant in physical, but they needed ON24's digital expertise to capture that high-quality digital engagement data.
Allowing them to truly own the full hybrid customer journey.
That's the goal.
All right, let's talk about the cold financial analysis, the investor context. Even with this critical strategic need, that valuation, it needs some justification. 2.41 times sales is a bunchy multiple.
It is, especially when you consider where ON24 stock had been trading. But the strategic goal is clearly focused on achieving substantial operational synergies.
And leveraging the integrated tech stack across both customer bases.
Exactly.
How significant are those synergies? Streamlining is promising something like $50 million annually.
$50 million is their target. It's for reducing overlapping technology, merging duplicate data infrastructure, and streamlining their sales and general ops, if they hit that number.
It makes the acquisition look very smart very quickly.
It does.
But let's introduce some critical thinking here, because $50 million in synergies sounds great in a press release, but integrating two major complex temp platforms is notoriously difficult. It's where these M&A deals often fail.
That's an essential question to ask.
So what are the key execution risks? What could derail that $50 million target?
The biggest risk is cultural integration and technical debt. ON24's platform is highly specialized in digital engagement. Its data architecture is tuned for speed and granularity. Cvent is built for scale and logistics, hotel room blocks, payment processing.
Two very different beasts.
Very different. Merging those two distinct data infrastructures without breaking the core functionality of either platform or alienating existing customers during the transition is a massive technological undertaking.
So the risk is that in the pursuit of those cost savings, you actually hurt the core user experience.
Exactly, making the combined platform less agile than the two separate tools were.
That's a huge point. But assuming Cvent executes this successfully, this combined entity is perfectly positioned to serve what you call the portfolio approach. Tell us more about that.
We've seen a permanent shift away from depending on the single mega conference, that one enormous annual event where a company sinks 80% of its budget.
Right.
Organizations are now prioritizing a portfolio of smaller regional gatherings, micro events.
And why is that shift happening? Is it just budget cuts?
It's ROI. Smaller, more targeted events offer a better return on investment. Deeper engagement because they're less overwhelming. And they're easier to scale globally.
So budgets aren't being cut, they're being reallocated.
Reallocated to smarter, more measurable outcomes. Driving specific pipeline growth, securing deposits, boosting retention, not just maximizing a general attendance figure.
So the Cvent ON24 merger creates an entity that's perfectly suited to manage that hybrid portfolio.
Perfectly. Offering physical event planning globally, combined with seamless digital content delivery and lead scoring, all feeding into one unified data suite.
This combination just dramatically changes the competitive landscape.
It does. Competitors are now forced to integrate or partner up just to match Cvent's scale and the completeness of its offering. The core value proposition is now measurable, compliant outcomes.
Connecting marketing spend directly to pipeline and revenue.
Not just managing headcount. And on top of that, you have tightening security requirements. Things like PCI DSS for payment handling. That makes fragmented, smaller solutions increasingly risky and expensive for enterprises to manage. Only the big, integrated platforms can handle that security burden globally.
Exactly.
Let's transition now to look at the immediate implications of this for the broader market. For ON24, the path is clear. It's a strategic asset under a big umbrella now. So the actionable insight for you, the listener, lies in what this means for the players left standing.
Right.
We spent this whole deep dive establishing the forces at play: the death of third-party data, the need for integration, the focus on compliant first-party data capture. So if we were pitching a trade idea based on these trends, where are the winners and losers?
Okay, so we're proposing an event-driven paired trade. It's a bet, explicitly, against fragmentation and for deep integration.
I'm ready. Lay out the thinking. Our short idea. We recommend shorting a small cap, pure play virtual event or webinar platform, one that relies heavily on charging for marketing services and whose data tracking is still heavily dependent on legacy third-party methods.
And the structural argument being?
The era of the fragmented single-function virtual tool is over. The new Cvent and ON24 entity is just so large that the small dedicated virtual players will be squeezed out. Their core product hosting a digital event is now just a feature inside the dominant platform.
They lack the scale, the financial backing.
And the data compliance required for enterprise budgets in 2026. This whole segment becomes a commodity play, and it's getting squeezed by both market leaders and regulatory pressure.
Aggressive but structurally sound. Fragmentation is the new risk. So if we're shorting the fragmented pure play, what's our long idea to pair it with?
We take a long position in an event technology vendor that is natively and deeply built within a major CRM ecosystem. Salesforce is the prime example, but any vendor that operates at that deep infrastructure level.
Why the exclusive focus on native CRM linkage?
Because the industry's priority is immediate sales action based on that first-party data. Event data is useless if it's sitting in a silo.
Right.
Betting on the natively integrated vendor means you're betting on zero latency data flow from event engagement directly into the core system of record, the CRM for instant follow-up.
So you believe that deep native integration and end-to-end data compliance will be the key differentiator for winning event budgets in 2026.
That's the bet. This acquisition confirms that integration is king, and the closer you can get to the customer record, the better.
That wraps up our deep dive into the Cvent ON24 merger. Let's quickly consolidate the essential takeaways for you.
This was a highly strategic $400 million all-cash deal. It delivered a massive 62% premium. The value was justified by ON24's AI-driven digital engagement tools and its ability to capture compliant, high-intent first-party data.
And Cvent has successfully integrated that critical digital expertise into its traditional event dominance. It's created a formidable heavyweight designed to dominate the hybrid event market globally. The structural drivers, the pivot away from unreliable third-party data, the operational need for a single integrated tech stack, and that industry shift towards smaller regional event portfolios, that's what truly justified the premium valuation.
This wasn't about cheap growth. It was about market control and future-proofing your entire data strategy.
Indeed. And for our final provocative thought for you to consider, given this accelerating trend toward regional events and tighter data compliance, what's Cvent's next move? Will their future M&A strategy target niche physical event services like specialized badging or hyper-local check-in providers to bolt on for that comprehensive portfolio service?
Or will they just focus on acquiring the few remaining standalone digital engagement platforms that have managed to hold their own?
The market has clearly chosen integration over fragmentation. Thank you for joining us for this deep dive into the strategic forces shaping enterprise marketing.
We'll catch you next time.